In this business, my work is based on the trust that my customers give me, and I can't lose this trust. If they ask me to customize something to make it this way or that way, I definitely have to deliver and make it happen.
Well, trust is the foundation of our business. We're not talking about a few thousands of pesos given to us for safekeeping. We're talking about hardworking folks like yourself entrusting with us billions of pesos to manage for them in a good and responsible way.
The challenge is to keep this trust, even though there are so many things that are beyond my control.
Because we need to make our clients' money grow. Like you, we do our research. We look at many factors: the economy, politics, what's going on abroad. All of these things affect business. But we don't want our clients to be left behind. We want to bring you to the forefront of new ideas. We want to bring you to industries that you may have never even thought of investing before. We want to do this for you and bring you to worlds of investing that you may know nothing about.
What is important to you is important to us too. Your values are our values. Clients know that we mean what we say. They have now entrusted ATRAM, a multi-awarded asset management company, with their investments. Each day, we wake up with fresh ambitions, wanting to do what matters to us, for people who matter to us. We do what we have to do. We live for today and work for the future. We are ATRAM. Your future, our present.
Hello and good morning, everyone. Thank you for joining this week's episode of ATRAM's webinar series. Today, we'll be talking about updates in the market as well as our outlook. I am Paolo Delior, Business Development Manager at ATRAM. I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day as well as posted on all our social media pages. Make sure to stay until the end as we will be wrapping up with a feedback survey. Joining us once again this morning is ATRAM's Chief Investment Officer, Mr. Phillip Hagedorn. Welcome, Phil. Happy to have you back, and hopefully you have some exciting news to share with our viewers this morning.
Hey, Paolo, good to see you and good to be here. I'm looking forward to this update for today.
All right, the floor is yours, Phil.
Well, thank you, and good morning to everybody. Thank you for joining us again today. It's always a pleasure to be here and share our views with all of you. Maybe just a quick summary or executive summary of what we're going to be doing today. What we'll look at first and very quickly is an update on the health crisis. And clearly this is still what's driving the economic crisis that we're in. And we'll share with you some of the news and some of the data that we have and that we're seeing with regards to this. Second is we'll have a chat about expectations on consumption. So if you recall in May, we ran a survey here at ATRAM at our website, at our webinar. And that survey was quite telling. I think it shows that, and we'll show you some of the results versus the actual numbers that came out. And it kind of shows that it was a good indicator of what the expectations for the second quarter were. And so we'll be running that survey again today and get a feel of how you all feel about this recovery that we may be in and what patterns we may be looking at for consumption in the second half of this year, no? Or at least for the remaining 4 months that we have. We'll also talk a little bit about our strategies and how we've remained flexible to take advantage of many of these opportunities that are out there today. No? So let's start with an update on the health crisis. And on the next slide, you'll see, I think overall, we're more positive about what's going on. First of all, our testing capacity has increased significantly. Over the last few weeks, we're testing well over 25,000 people a day. It's the highest testing capacity in Asia, apparently. And it's allowed us to have a more accurate feel of the epidemic and where the hotspots may be. The good news is that we are seeing the positive rates drop. That gray line that you're seeing there, after peaking at around 10%, 14%, somewhere there, it's now dropping closer to the 10% range. One thing that we need to consider also is the improvements in tracing, in contact tracing, and I think as we continue to improve contact tracing, we get a better handle of where this pandemic is. But overall, more testing and a dropping positive rate is good news. Also that we have bed capacity. Recall that when the government went back into a more stringent lockdown in August, this was because our bed capacities had gone above 70% in the NCR. As a matter of fact, close to 80%. Today, they've dropped significantly, well below 70%. Well, 63% is where we are today. And that gives us confidence as well that our capacity in the health system seems to be adequate in terms of dealing with the crisis at hand. The next slide is probably the most important, which is the reproduction number. So as you recall, early in the pandemic, for every person infected, 2.5 people were getting infected at the peak. And that peak has dropped from 2.5 to 2 to 1.5 in August, and finally dropping below 1. The goal would be somewhere around 0.7, but the good news is that for every person infected today, less than 1 person is getting infected. And that's supporting the improvement in the doubling time. So in the worst case that we had, the doubling time, so for the number of cases to double, was about 14 days at the worst case. That's been pushed out to 60 days. Obviously, we want that to go to as many days as possible. But again, it's showing proof of improvement that we are managing the health crisis better. And ultimately, what does that mean? It means that we're likely to get a lighter quarantine restrictions starting in October. And I think the discussion is that we will be in MGCQ starting in October, which I think the big change there will be that there will be access to public transportation, which will allow people to get to work. And so I think that's a next milestone for us to achieve in the short term. And so overall, I think we can be a little bit more confident that the health crisis is being managed and the infection is being controlled. But as we all know, we must remain vigilant. This is not over. And normally when you let your guard down is when things can get worse again. So we must remain vigilant. We must continue to social distance and continue to wear masks, etc. But the trend is good, and it's driving a little bit more optimism for the future as we speak. So I want to switch gears now and talk about our expectations on consumption. And consumption is still our main barometer, as you all know. It's 58% of our GDP, driven by all of these factors, from beverages, alcoholic and non-alcoholic, to clothing and footwear, housing and electricity, furnishings and household equipment, health, transportation, communication, education, recreation, restaurants. This is what really drives our economy today. We all know we're not an exporting country. Much of this is driven by, obviously, people with work, and that's been a problem, and OFW remittances, which also have been challenged in the middle of this year. So we'll kind of have a look at how how that has developed over the last few months. No? I mean, the next slide is just a quote, and it's a quote from Niall Fitzgerald. Basically, it's this consumer spending that's going to dictate whether the country is in business or not. And if you look at the next slide, it's a clear indication of that. No? This is GDP in the light blue chart. So we saw GDP drop all the way down to 16%, minus 16% in the second quarter of this year. And primarily driven by a drop in household consumption of about 50%. And when you look at the actual numbers, this is the personal consumption breakdown. Clearly, we're seeing major drops in expenditures in these areas. The largest hit was restaurants and hotels, down 66%. Transport was down 60%. Recreation and culture down 57%. Buying clothing and footwear down significantly, 40%. Alcohol and tobacco down 30%. And there were some bright spots. You had housing, water, utilities actually up. So I guess more people staying at home is more electricity spent, more water spent at the home. Communication, so I guess more internet, more telephone, more load being used. And of course, food and beverage, which is the largest component of this whole basket. The good news is people are still eating their 3 square meals a day. I hope in most cases. It seems even in the most challenged of family and family income levels, there is support from the government to at least maintain that 3 meal a day target. So I guess what we wanted to see is how this numbers compared, sort of, versus what we expected back in May. Because if you recall, we did do our survey in May. And the next slide, I think, gives you a bit of a peek at that. So in May, we asked questions around education. So 75% of the audience in May said that homeschooling would be preferred at this point, and we know that that's where most of the kids are today. At the same time, 73% of you thought that tuition fees would be either less or the same, and certainly tuition fees have dropped around 12%, or educational expense has dropped about 12%. Transportation, 84% of you thought you would use the car less in the next 6 months, and as the second quarter came out, you saw it's a significant number down, almost 60% down. Purchases of home appliances, smartphones, recreation was down 57%. 73% of you felt that was going to be the case, so very accurate as well. Data plans. Many of you said you would increase or not change your plan. 98% said either an increase or no change in the plan. Nobody said they would decrease, basically. And certainly we've seen an increase in spending there. And finally, 93% of you said you would not be going out to restaurants. And we see a massive drop in spending of 66% in restaurants. So the point, I think, is that our survey was quite forward-looking. It gave us a hint of what things will look like, no? as we move along. And for that reason, we wanted to run this survey again today and try to get a gauge of how you feel looking forward. So between today and Christmas, what the thinking will be as far as spending versus the period of lockdown. Because that's the period behind us. So Paulo,
Yes, Bill.
these questions are the same questions that we asked last May, no?
Right.
And we'll start with this first one. From today up to Christmas, and I hope everyone can participate in this poll, For travels to the office and out of town, do you expect your use of your car versus the last year to be more often, same, or less? I would compare it to the quarantine period, Paolo. So since quarantine, that was the last time we took the survey. You think you're going to use your car more, same, or less often in the next 4 months as we approach December? So that's the first one. And if you can all submit the answers, I will look at them now. And we're still significantly on the less often, seems that way. No? 64% of you say less often, but a bigger number now saying that maybe more often, 19%. After we run the surveys, Jomar Lacson will help analyze the results and look at we'll look at how they compare versus our outlook for the second half of the year. No? So less often is a winner, but more often has more votes, I think, than the last time. The next question is, from today up to Christmas, do you plan or desire to upgrade, downgrade, or do nothing with your data plan? So last time there was almost nobody said downgrade. Most said either upgrade or do nothing. And let's see the results. Do we have results? So I guess most of us have already upgraded. So many of us are saying do nothing and very few people saying to downgrade. So maybe some folks think kulang pa yung upgrade. I know I am, because my kids at home using the internet for their Zoom classes are taking up all of my bandwidth. So I had to upgrade myself. So the next question is from today up to Christmas. You have kids in school. Do you expect tuition fees, any changes in tuition fees relative to the first half, or do you think tuition fees will go up, down, or stay the same? Well, I guess we're in a new school year already, so I would say it'd be probably very limited in terms of difference. And results, please. So actually, we're still overwhelmingly either staying the same or being reduced further. Interesting to note that. The next question, please. Again, on schooling, would you consider still homeschooling or strictly distance learning is the option? I think people will be homeschooling. So I guess that's the overwhelming response, that we'll still be homeschooling from now through Christmas. I think the last question, if I'm not mistaken, is this our last question?
Second to the last.
Second to the last. So
Yes.
Again, it's about buying home appliances, smartphones, tablets, gadgets. Do you plan or desire to buy anything new for the home, for yourself, for your family? Personally, I don't think I will be. Let's see the results. Still, 33% still think that they're going to start to spend on some gadgets. Good to know. So it looks like some confidence is coming back to spend. And finally, the last question. I think this is the one where folks really need some confidence. Do you expect to go out more? Restaurants. I know the salons and barber shops will probably be open if we open up into the MGCQ level. So consider that we will be in MGCQ in October, and I guess starting in October, if we do open up to MGCQ, would you tend to go out the same number of times as you did in the last 4 or 5 months, less often or more often. And still less often. Wow. So I guess many people are still very concerned about the health crisis. So thank you. Thank you for participating in the survey. And maybe now we'll ask Jomar to come in and give us a bit of a hint as to what the results of this survey are. Jomar?
Hi, Phil. Yeah, just looking at the for education on the homeschooling, there's more for this survey, this round of survey that said yes that they would consider homeschooling at around 92% versus the previous of 75%. And with respect to tuition fee increases, we note that there's more an increase in towards reduction in tuition fees of 64% versus previously we were just only 26% were expecting a reduction in tuition fee increases in tuition fees. With respect to recreation, meaning the purchase of the smartphone, it's still the same, slightly higher. 33% said yes that they will be buying a smartphone over the next few months versus 27% previously. But in terms of car usage, there's more of 52%. So there's actually more people who expect to be using cars versus before, wherein was the bulk was really on the less portion. And for your communications, the data plan, it's roughly the same. It's more of the not changing their data plans to 70% versus 67% previously. So there is still some room for slight improvement with respect to for communications, but it seems that more people in this round are looking at more mobility, at least with respect to personal transportation.
Thank you, Jomar. I think, yeah, I was looking at it. It looks like a little bit more mobility, but still concerned about the public areas. So maybe it's more towards work and things like that. No?
Right.
So I want to share now our outlook, because I didn't want to share this before the survey and try to influence anyone. But our outlook for the second half is quite consistent with actually the survey, I think. What you have here are two numbers. The first numbers are the second quarter numbers in terms of spending. And I think generally we're looking for improvement, but certainly not out of the woods yet as far as the economy is concerned. So we're going to expect slight improvements. And if you look across the large areas like restaurants and hotels, which were down 66%, recreation and culture and transport, 57 and 60%. We're going to see some improvement, but it's still a long ways to go to recover. No? And I think that's kind of in line with the survey that we did, where people will be willing to be a bit more mobile and moving around, but still very cautious. Even on education, we're expecting still a drop of 10% for the second half of 2020 in terms of the spend there. So very consistent, and I think very consistent with also the view of our audience today as far as how spending might develop in the second half of 2020. So if we look at some data now, next slide, I think we're talking about some minor positives that I want to point out. But again, with the caveat that there's still a lot to be done. Similar to the health crisis, we cannot take our eye off the ball at this point. And initially on unemployment, we were very worried. That number was getting to about 18%. The more recent news that we've seen in unemployment has been more positive, but it's a very big change to what we've seen. We lost a lot of jobs, particularly in the services sector, but gained them in the agri sector. the explanation is that many people that have left Metro Manila because they lost their jobs have gone back to the province and have found work. The difference, obviously, is that the work is not paying as much as it would have in Metro Manila. At least that's the view. So the spending power of those folks will not be as significant as it was, but at least they have a job, and it seems like they are covering their basic necessities. We will be watching this unemployment number, but we think the big move has been done. It's now for the economy to start recovering again in a much more significant way that will allow us to continue to eat into this unemployment number. So we don't expect the continuation of this drastic improvement in the short term. Maybe a bit of flattening out at a bit of a higher level in the coming months. The next slide talks a little bit about the remittances, and we were concerned because in April and May, we saw very drastic drops in growth rates. But since May, we've started to see recovery. The growth rate is recovering. The absolute number is back above 2 billion pesos a month. And so we're less worried that this was going to disappear in a big way. So I think we think that OFW remittances are on the comeback. They still have a ways to go to get back to the dollar levels they were at last year. But the peso has also appreciated about 6.5% versus the dollar. So technically, they need to send in less dollars to generate the same amount of peso for the consumers today. So that's that factor combined with the factor that inflation has been very benign, still below 3% and expected to remain that way. I guess the purchasing power of those that receive OFW remittances have been affected, but not as severely as maybe we anticipated early on in this pandemic. So my last slide is really just to think about some investment points. First of all, that the economy is breathing better. I don't think we're out of the respirator yet in the pandemic sense. We still need the respirator, and this respirator has to do with fiscal stimulus, which there has been fiscal stimulus introduced, but we feel it's still relatively inadequate for the gap in the economy that's been created by the pandemic. We have lost about 2 trillion pesos in value in our economy. And the fiscal stimulus since Bayanihan 1 was kicked off is just over 500 billion. So we need more stimulus to allow the country to get off the respirator and start breathing on its own. We think part of this is also the lifting of quarantine requirements. So allowing public transport to start off and people to get back to work will be a big factor for this to happen. Don't read the unemployment improvement as a sustained one. By no means are we out of the woods here, and it can get worse. There's still a situation where the unemployment number can get worse, but we're confident that if the economy continues to open up and fiscal stimulus is pumped in, then many small companies can be saved, and the unemployment number can continue to improve in a much more stable way, or slower improvement, but improving nonetheless. And ultimately, what it means is being flexible in your portfolios. In our equity strategies, we have really concentrated the portfolios on large cap liquid names that allow us to be tactical. In our multi-asset portfolios, We have gone back to neutral in our Philippine equity space, which we were slight underweights in the last month, although we remain underweight in global equities, as global equities are still consolidating. I think we have a very positive outlook long term on the healthcare and tech sector, and those are sectors we still want to invest in. But in the meantime, the U.S. market has zoomed up. As we know, it's up still around 2 to 3% earlier this week. It's been consolidating. But compared to the Philippine market, which is down 22%, it's done very well. And being flexible and maintaining our view on those sectors is still our outlook for global equities. On the fixed income space, we are expecting rates to slowly move up, but stay at the very low end of the range. So we're not expecting any major moves in fixed income. We think the U.S. has very little room to cut from where they are today. And so the Philippines is probably in the same situation where we're not likely to see a cut in the short term. And moving into our view for next year, we do expect rates to slightly move higher. So that is the last slide I think that I have, and I'm happy to, Paolo, take questions from the floor if there are any today.
Thanks for that very comprehensive update and outlook, Phil. So first question from our audience is, do you think net foreign selling in the stock market will persist for the remainder of the year, considering our improvement in our pandemic management efforts?
I don't think there's a lot of foreign investment that's passive or short-term in the market anymore. Foreigners at the peak will own about 31% of Philippine stocks, right? That's their normal ownership. The ownership level now has dropped to, I think it's somewhere around 22%. So 1/3 has been cut away. But we have to remember there are foreign investors that have strategic investments in the Philippines. No? For example, First Pacific owns a big part of PLDT. So these type of strategic investments we think will stay around. As a matter of fact, KKR, for example, a large, important investment group in the U.S., has recently purchased Philippine assets. No? I don't think there's a lot of passive money. So those investors that tend to take positions in the Philippines via buying an ETF, for example, right now the Philippines is not in their radar screen, and I don't blame them. When you look at a global portfolio, the weight of the Philippines is like 0.5% of a global portfolio. So you're not going to put a lot of time and energy today, considering this crisis is global, and every single market in the world is affected by it, on the Philippines, because it plays such a small role in a global portfolio. But for us, Philippine managers, we're the ones that are seeing this value, and we have certainly reduced our cash levels today because we're more optimistic about the market. We have a downside scenario where we had 40% probability of that downside scenario coming into play, and we've recently reduced that from 40 to 30%. So that's a good thing, but it's still 30%. So it's not completely out of the woods. And so for this factor, I don't think we're going to see heavy foreign selling. I wouldn't be surprised if it continues, but I don't expect it to match what we've seen in the first 8 months of this year.
All right, thank you, Phil. Questions are pouring in from our audience. I got one here. Where do we go from here? Will 2021 be a good time to reopen my business if the government is allowing 30 to 50% dine-in customers? I'm guessing it's a restaurant business, whereas 80% of sales are coming from this area pre-COVID. Will the restaurants pick up next year?
We think they will. I mean, the confidence has to come back that people have to go out. I mean, if you're a restaurant that, let's say a single restaurant that, doesn't have a delivery system, it's going to be a bit tough unless you're a small restaurant, you have a specific market. If you're in the malls, for example, I think that until people feel a lot more comfortable about going into malls, it's going to be difficult. Restaurant owners are among the toughest hit, actually. And I would really look at, you have the opportunity first of seeing if you can run your business in a more efficient way. You need the same staff. Many restaurant owners I've spoken to are saying the realization that they're seeing is that they can run their business with much less staff than they had in the past. They're just being more efficient, whether because deliveries is a bigger part of the business than it was in the past, or people just value their job so much more that they're more productive, and thus you can keep your costs down and continue to run the business. So I think it will depend on where your restaurant is, number one, because I think if you're outside of the malls, you probably have, and of course in a high traffic area, you probably have a better chance of getting some customers in the short term than you would if you were in a mall. That would be my guess.
All right. Thanks for that, Phil. At this time, would you consider adding global stocks and down weighting on Philippine stocks in a diversified portfolio?
Well, our multi-asset portfolios, we were underweight both global equities and Philippine equities, in August. We started to increase Philippine equities more recently, and last week we went to a neutral position on Philippine equities. So we think Philippine equities has some catch up to do versus global equities. Global equities have had a fantastic run. Of course, we're seeing some pullback now, and it's not unexpected. I think, everything needs a bit of a pullback when you run up so quickly. But is the long-term outlook different? Are we changing our view where we don't like tech and we don't like healthcare? No. We think tech and healthcare are going to be areas that are going to continue to grow. And so what we've done in the global space is added a component of China tech to our tech strategy. We were more focused on developed market tech and exposure. And a recent shift is to add more emerging market exposure to that, where there's higher growth. The PE multiple is a little higher, but there's more growth. As far as global equities are concerned, this might be a good time to look at global equities. We are not yet going neutral, but I think we're very close to pulling the trigger on that if we see a bit more of a correction in that market. In the meantime, on the Philippine space, we've gone neutral already. So we think that the rally that we started last week, where we had the market finally showing signs of life, Paolo, I hope and expect that continues in a more gradual way over the next few weeks.
Yes, and funny that you mentioned tech, Phil. There's a question from the audience. Should we wait for a major pullback before investing again for global tech funds for long-term goals?
Timing is the hardest thing to do. So, I think it's a great time. There is an opportunity to invest in these sectors. And if you haven't already, then I would suggest just spreading your buying out. Because if I knew where the bottom was, I'd love to be able to tell you that. Is the opportunity in tech still a good opportunity? Yes. Can you maybe buy it cheaper? Probably. But is that going to be this week, next month? I don't know. And so what we're doing is slowly adding to that position and being comfortable with as we add. I don't think that the tech market will fall out of bed. But clearly, earnings is going to have to support the high multiples that we're seeing in that sector today, and that's, I think, where the investors' concern lies. So it would be a good time, but I wouldn't say load up. I would say it's a good time to start picking, dipping your feet in, and spreading your buying out over a period of time.
All right. Thanks for that, Phil. What flexibility of investment are you recommending for mutual fund investors?
Well, I would be adding a little bit more risk to your portfolios today, if not. If you were in a total return bond fund or a corporate bond fund or money market, maybe it's a good time to go into a balanced fund. Get some of that equity exposure. We've had a nice consolidation. Remember, the market peaked at 6,400 earlier this year. I see no reason why we shouldn't see 6,400 again before the end of the year, assuming that the economy opens up and we continue to manage the health crisis in the positive way that we're doing. So, there's upside to that 6,400 of almost 10%, right, from where we are today. So to get some of that action, you need to be in equities. And so having a balanced fund. Now, would I sell all my fixed income and go long equities at this point? No. I think that's where you have to have a bit of balance and make sure that you're not putting all your eggs in that one asset class basket because of that 30% possibility that the downside still exists. No?
All right. How about we take a look at sector-specific questions? What's your outlook on real estate? Would there be contraction in prices of residential homes or condos?
We're seeing a little bit of that. There doesn't seem to be a lot of pressure to sell just yet. On the condo market, what I understand is the occupancy rate is going up. Maybe it's related to some of this Chinese tourists, Chinese pogos, less activity in that sector. So my understanding is you're seeing more availability, more units available. But we're not seeing a deluge of units for sale just yet. In the housing sector, it seems to be the same way. Makati prices, there seems to be some correction going on and more property in the market, but no panic. I think it's probably a correction or consolidation rather than a major sell-off. So we'll see how things develop. I mean, I think the Bayanihan law has staved some of this off because there's no pressure to pay mortgages very quickly. And I think we'll have to wait till probably the fourth quarter or first quarter of next year to see how much pressure there will be in this sector. The office space is what seems quite resilient. There could be talks of negotiating rents downward, which is possible. But again, there's still quite a bit of demand. Although pogos may be leaving, it seems like the BPO sector is picking up again. So maybe a bit of good news on that front.
All right. How about for the travel and leisure sector? Airlines, hotels?
Well, this will be the last to recover. I think anything related to travel, hotels, recreation, it's going to be a slow grind this year. I don't want to speculate on when there will be a virus, but for all of that to recover, people have to have more confidence. And if our survey is any indicator of that, I think 84% said they weren't going to be going anywhere, right? I won't speculate on vaccines, but it's more about the comfort zone. I think there's a factor of the government having stuff under control, so people get more confidence to move out. And obviously, if there's a vaccine, that's going to be the big win, but impossible to say when that's going to happen.
All right. So if recovery kicks in next year, would now be a good time to load up on cyclical stocks?
I'm afraid of the load up. It's like load up means, I'm going to go long, sell everything I have and put it in stocks. I think you have to be careful. These sectors in the Philippines, the cyclicals, it's the market leaders, right? You want to go for the market leaders at this point. The ones that are going to survive this and come out with more market share, and a chance of recovering earnings, getting back to 2019 earnings. And we think that next year, we're only going to approximate about 86% of 2019 earnings next year. So that's the average. Some will be above 100 and some will be well below. And what we want to do is invest in the companies that are going to be, above the 100% earnings recovery number.
All right, thanks for that, Phil. And for the last question, how about local and global consumer spending? I guess the audience wants to know where you see this will go. And
I think the survey, I'm going to answer the question with the way the survey came out. I mean, there still seems to be very little confidence in the Philippines. In the US, these guys are a different animal altogether. They've all been out. I have cousins and family in Spain. Things are moving along and the health crisis is not getting any better. People are out spending and going on summer vacations and, that's not happening in the Philippines. I think there's a lot more cautiousness here than there are in some of these developed markets. So I'll focus on the Philippines. I think we're not going to see a massive, I think even if we go into an MGCQ next month, I don't expect, Paolo, you're going to be running out to the malls, right?
Yeah.
Maybe yesterday you did a lot of 9.9 buying on Lazada, but I think it's going to be more of the same of what we saw, with slight improvements of folks that can head back to work, public transport being open, so more mobility, and making sure that we can continue to control the health crisis. I think that's still the theme, but my feeling is we're more optimistic. So we're seeing numbers improve, and that's all we can ask for. It's a sequential improvement month on month that we're looking for.
All right, thanks for that, Phil. Before I close, would you have any final words for our viewers?
Well, again, just thank you for joining us today, and I hope we were able to share something that you can take home with you and help you in your decision making. And if you need more help on that, please contact us, and happy to share our views, thoughts on how we're managing and what we want to do as we move on towards the Burr months and Jo Marie Chan's songs.
Thank you for that, Phil. I think we could leave it there for this webinar. Thank you to our audience as well. If you have any further questions or would like to know more about ATRAM's funds, strategies, please get in touch with your relevant ATRAM relationship manager or visit our website, www.atram.com.ph. Lastly, please answer the survey at the end of the session, as your feedback is valuable to us. We appreciate you taking the time to join, and on behalf of ATRAM, I would like to wish for the safety of you and your family. Best of luck. Thank you very much and have a great day.
Thank you, everybody.